if you are an option buyer on Thursday, okay, stock's trading at, I don't know, 123, and you go in and you buy the 122.50 call option for $1.50, $1.20. You can buy it for $1.20. You go in and you buy this option, okay? And it's Thursday. How much time value does this option have in it? In other words, how much risk of time value decay did you just purchase? There you go. Very good. Connie's got it. Julie's got it. Jose, Lou, excellent. You just bought 70 cents of time value, guys. If you take this option apart and you look at this option, there are 50 cents of intrinsic value, and there's 70 cents of time value in this option. Now, that may not seem all that significant or important to you, but if you buy this option on Thursday, that 70 cents of time value is subject to time value decay. It is established by the implied volatility. The market maker can manipulate that as he sees fit. From Thursday, when you bought the option, to Friday morning, okay, from Thursday to Friday, overnight, we go from 24 hours of available time to expiration to 6.5 hours of available time to expiration. That's what happens from Thursday night to Friday morning in the options world. You bought an option which the vast majority of the option is subject to a collapse in time value because of the biggest drop in available time to expiration in the entire options life cycle. It is entirely possible that if the stock does not move at all, if Friday morning the stock's trading at 123, your 122.50 call option would now be worth about 70 cents. Maybe a little bit more, maybe 80. Let's go with 70 because it hurts more. In other words, on Friday morning, if you break this option price down again, Friday morning, your option, assuming no movement in the price of the stock, your option would still have 50 cents of intrinsic value, but it would now have 20 cents of time value, which makes sense because it's Friday. This option is going to expire. So we don't want to buy options that have a lot of time value on Thursday. Doesn't make any sense. So we look for options that are mostly intrinsic value, right? Winds come down and it looks like they're going to close the gap. And that brings me to Ken's question. Ken earlier said, if wind comes down, closes the gap, and bounces at the 5 moving average, could you use that as a new entry? And the answer is yes, you could, Ken. And if you do, you would want to buy an option that is mostly intrinsic value because today is Thursday.